Afternoon. Welcome to our first UOBAM Robo-Invest performance webinar. A very big thank you for spending your lunchtime with us today. So I'm Roger, a member of the UOBAM Customer Success Team, and today we are delighted to invite Mr. Dharmo to give us an insights into how the performance of the Robo-Invest have done over the first quarter of 2022. Before we start, I'll just run through some housekeeping rules as well. So there is a chat box that is available. If you have any connectivity issues, feel free to raise it up to our host as well. We do not have any polls for this webinar today, but we do have the Q&A icon where you can actually ask any questions that you are keen, that you would like to find out throughout the session as well. And also, if you wish to, you can actually click onto the like button, which you can upvote the questions raised in the Q&A section. At the end of it, we will provide you with these QR codes as well for you to actually access the feedback form and for you to fill up the feedback form as well. Next. So the agenda today will just cover the market commentary, the Q1 performance of UOBAM Robo-Invest, and also for Dharmo to speak about the market outlook and the strategy. At the end of the session, I will touch on a little bit of what exactly is UOBAM Robo-Invest. As will be noted that in today's audience today, there are people that actually, there are clients actually that are non-UOBAM Robo-Invest clients. So I'll touch on a little bit on that. And we also have an ongoing promotions that we actually would like to share with our clients today. Without further ado, let's get Dharmo to present. Dharmo, please.
Thanks, Roger. Let me get my video started. Yeah, okay, great. Good afternoon, everyone. Thanks for joining us at this performance review webinar. Let me jump right into the market in first quarter. I think if you've been investing or you've been involved in the stock market or in financial market, you realize that the first quarter has really been a challenging time. And I think there are probably a couple of surprises that sprung on us in the first quarter, right? The first surprise that nobody could foresee was this, the invasion of Ukraine by Russia. And as a result, what we saw was that oil prices actually jumped, right? Since the end of the year, it was about 100. At its peak, it jumped to almost 140. Today is probably about 110, but basically the invasion of Ukraine was actually one surprise that nobody foresaw. Everyone thought that it would be a lot of saber rattling, but no one expected a war to break out, right? And the second surprise that we saw was this: the central banks, the global central banks, became more hawkish since the beginning of the year because inflation was very, very sticky. I think what this chart is showing, the light blue line, actually shows the number of interest rate hikes that the market was expecting for this year by the US Federal Reserve. If you look at it, in December 2021 or end of last year, beginning of this year, people were expecting, roughly speaking, that the Fed would hike 3 times. But that expectation climbed very, very fast. And by end of March, actually the expectation is now about 8 to 9 times, meaning that people are expecting the Fed to hike 8 to 9 times this year. If it happens, this would be the tightest or the most aggressive that we've seen the Fed raise interest rates since 1994, right? And as a result of this expectation of interest rate hikes, bond yield also jumped, right? So at the beginning of the year, bond yield was about 1.5. By the end of March, it was about 2.4. And yesterday, of course, it was about 2.9. So basically, what we saw is a very sharp jump in bond yield as a result of the expectation that the central banks would be very aggressive to tighten monetary policy by hiking interest rates. And the reasons why it is the expectations are so elevated is this. If we go to the next slide, what we see really is that the inflation has continued to climb and has actually climbed to a very high level. This is the US CPI number. The red line is the headline numbers, and that has actually reached about 8.5% in March, right? The core, that means excluding food and energy, is also about 6.5%. So basically, inflation are actually at very elevated level. Bear in mind that since the great financial crisis since 2007, that number has actually struggled to go above 2%. And before this, it's roughly been about 2% in the last couple of years. But now we are running at 8 to 9%. And there are various reasons for it. One is, of course, there is the supply bottlenecks that we've seen, whether you're talking about shortage of chips, and as a result, there are fewer cars being built, and used car prices have been going up in the US. As the economy reopens, basically people start traveling, there's pent-up demand. Airline tickets prices have been going up, hotel prices have been going up. So things like these have actually all filtered into the inflation number. And of course, the oil price, the invasion of Ukraine caused the jump in oil price, and that again is filtering into the inflation number. And also, of course, if you guys have been buying your groceries, you also know that besides petrol prices, food prices have been going up, right? Ukraine, Russia is one of the largest exporter of wheat and sunflower oil. And when there is disruption, basically all these prices goes up. And then, of course, related to that, all the substitutes also went up in prices. So what we're seeing is that inflation is going up with no sign of it coming down yet, right? If I may go to the next slide. This is what we see in Europe. Basically, it's the same picture that we are seeing. Eurozone obviously is the CPI is hitting about 6%. And Eurozone might actually be even more impacted simply because the Europe is highly reliant on Russia for its energy supply, whether oil and gas, right? So if there is disruption or there's sanctions on Russia, Europe would probably feel the impact the hardest. I think electricity prices have been going up in the Europe area, especially during the winter months. The heating fuel and electricity prices have gone up tremendously. So I think what we've seen is that in the developed world, inflation is actually now a problem, and therefore central banks are forced to be more aggressive in terms of hiking interest rates. If I may go to the next slide. And this is another wild card that only probably happened in March, about mid-March, but we foresee that this would actually have significant impact going into the second quarter of this year. This is China, and as you know, basically because of the COVID outbreak in China now, they've actually locked down, including some of the major cities like Shanghai and Shenzhen. And with that, basically, we expect to see a lot more supply chain bottlenecks as a result, right? China is the factory floor of the world, and when they lock down, a lot of things will not be produced. And even if it's produced, what we are hearing is that the Shanghai ports has closed down simply because of the lockdown. And with that, you're going to see manufactured products not being able to ship out of China, right? And if we see on the left-hand side of the chart, basically what we see is that the Chinese PMI has actually dipped below 50 as a result of this lockdown, right? So anything below 50 basically suggests that the economy is in contraction, and this is telling us China is likely in a contraction mode right now. So all this basically suggests that inflation will continue to remain high. And because of that, there will be no let up in terms of the central banks raising interest rate and tightening monetary policies. If I may go to the next slide. Right, so as a result of that, what have we seen? What we've seen is basically the market have actually sold off, right? Initially, sort of equity markets held off relatively well, as even when bond yield went up and bond prices came down. But once sort of the Ukraine invasion happened, equity market couldn't bear it much longer, and equity market sold off as well. And what we've seen is basically Asia actually took a bigger hit than even the global market. So besides the Russian invasion, China was also impacted because there were a lot of other noises, concerns about US sanctions on China, on its with regards to its support of Russia. As well as, of course, the lockdown in China is expected to impact the economy, and therefore Asian markets actually sold off harder than the global market since February. So as a result, the Asian market is down about 7.6%. Global market is down, roughly speaking, about 5%, right? If I may go to the next slide. The bond market basically, in the next slide, what we see is that the bond market is actually, the bond market actually was affected quite badly as well. If you look at it, the Asian high yield is actually down 10%. And at its worst, it was down actually about 15%. I think if you remember during that period of time, we are hearing a lot of default cases among the Chinese issuers, whether the Chinese property companies, especially the Chinese property companies that were defaulting on their bonds, and as a result, we saw a very sharp sell-off. We saw almost a 15% drawdown. There was a slight recovery in March. We ended the quarter about down 10% for Asian high yield. Even if we are talking about the investment grade bonds were down about almost 5%, and this is almost no difference between Asian and global. So this is a quarter, if you notice, this is a quarter that is a bit unusual in a sense that bonds actually did worse than equities. If you remember, the equity market is down about 4.8%. The bond market is down about 4.9%. So you would have, under normal circumstances, basically bonds should be less volatile than equities. Bond market should actually fall less than equities. This is really a very rare episode in which that bonds are actually more volatile than equities, right? The Asian high yield market is actually more volatile than the Asian equity market. So this basically really is a big anomaly. If I may go to the next slide. Now that you've seen sort of how the market has performed, let's take a look at how your portfolio has performed. And we're glad to say that we've actually managed the portfolio relatively decently. Well, I like to call it relatively well. We've basically controlled the drawdown of most of the portfolio. Bearing in mind just now, you saw that the bond market was down about 5%. But for our most conservative portfolio, in which that there are quite a significant portion of Asian bond and Sing government bond, as well as some equities in there, we actually controlled the drawdown to about 2.2% for the ESG portfolio and about 1.9% for the non-ESG portfolio. Right, so we've basically controlled, call it about 2% for the most conservative portfolio. And as I mentioned, this portfolio is invested in 40% in Asian bond. The 29% in money market fund actually probably helped, because money market fund generally tends to deliver a small positive return. And even our Asian bond, we've invested it in our SGD fund, and the SGD fund is very short duration. So that's why it helps to control the drawdown in this current market. I remember that our number is like -1% in for this quarter compared to -5% for the Asian bond, for the general Asian bond. I think equities probably took a bit of a hit here, but net, I think we've managed to control the losses to about 2%. On the next slide, we see the sort of a little slightly more aggressive, or the sort of conservative portfolio. In this instance, the return for the quarter is about -3.5%. Roughly speaking, again, there's 40% in Asian bond. This time round, the damage is probably inflicted by the US equity and the Asian ex-Japan equity. You notice that we've actually have about 40% of equity in this portfolio. I think that probably affected this portfolio a little bit more than the conservative portfolio. If I may go on to the next slide. The moderate portfolio, roughly speaking, is down about 4%. Again, if you remember that even bond market is down 5%, a moderate portfolio is down 4%, which is still relatively, which is still pretty decent. In this instance, Asian bond is 40% of the portfolio, and we actually increased the equity weight even higher. Now equities is roughly speaking about 60% of this portfolio. So this is a portfolio that is meant for moderate return in the longer term, and would hold about 60% equities and call it 40% in bonds, right? If I may go to the next slide. In this instant, there are more diversification. So besides the Asian equity and the US equity, we actually see global equity and US REITs coming into the picture. So the return is about -5% for this quarter. And basically this is as a result of some of the higher losses from the global equity. Next slide. On the most aggressive portfolio, we've sort of the losses is still roughly speaking about 5.15 to about 5.3. In this instance, we are seeing the global equity replacing the US equity, whereas Asian ex-Japan equity, this portfolio is actually 100% equity. My apologies. This portfolio is actually 100% equities. So we have about 40% in US equity, 40% in Asia ex-Japan equity, and 20% in global equity. And this basically gave us a portfolio that sort of returned -5%, given that the global equity was down about 4.8%, and Asian equity was down 7.7+%. We've sort of controlled the very aggressive portfolio at about -5% loss. That's basically the results of the allocation. I think the US equity probably helped us a bit, right? That's basically your performances for the 5 different portfolios, for the 5 different risk profiles. If I may go on and talk about what we expect going into this quarter, going forward. Right. We basically started the year with the view that the global economy will continue on the expansion path, right? At the beginning of the year, we said that this is mid-cycle. If you attended most of our webinars during that period of time, we say that the average economic cycle is somewhere between 5 to 10 years, with the average duration being about 8 years. And we said that since we've only seen the recovery in 2021, 2022 is only the second year of the recovery, we expect quite a few years more on the economic cycle. But what we haven't counted on is really the growth shock, right? The geopolitical risk and uncertainty because of the Russian invasion. That's the first growth shock. And then because of the high inflation, the sort of more aggressive central bank action, that's the second growth shock. And with that, it puts our mid-cycle view at risk, right? So it is still our base case. We are still not expecting a recession. A recession is still not our base case, but now we have to entertain that it is a possibility rather than a probability, right? So the odds of a recession happening has actually gone up, or if in our words, is that because of this growth shock, the cycle is accelerated, and we might be near the end of the cycle rather than the middle of a cycle. This is especially, I think, sometime in a few weeks back, we saw something called the inversion of the yield curve. What does that mean? That basically means that the 2-year interest rate, or the 2-year US government bond yield, was actually higher than the 10-year government bond yield, right? So how could it be that you have short-term interest rates that's higher than long-term interest rate? That doesn't make sense, because we all know that the longer you lend someone money, the more interest rate you should ask for, the more interest rate you should command. But 10-year bond yield was actually lower than 2-year bond yield. That basically tells, if you have been watching the CNN or reading the financial press, you would have heard this term in yield curve inversion. It basically usually foreshadow a recession, right? But what it really tells us, whether recession or no recession, what it really tells us is that the bond market is saying that the central bank is making a policy mistake, meaning that it is tightening too fast or tightening too much, that they expect that the economy will go into a recession as a result, right? So that is basically what the inversion of a yield curve, or a flat yield curve, is really telling us. So we basically look at the growth risk that's coming from the geopolitical uncertainty, from the aggressive monetary tightening, and then, as we mentioned, the China's situation is another wild card. Recession is now a possibility. So for us, we basically will closely monitor the situation, and we formulate our investment strategy. Few things that we are thinking of, obviously, is that one is, of course, there are possibility that we would put more money in Asia, and this is a few reasons. One is, of course, Asia is probably more insulated from the geopolitical situation in Russia and Ukraine. Europe is has a direct impact, feels the direct impact. US, to a certain extent, is involved in that situation. Asia is probably more insulated. That's really the first reason. Second reason is Asia is cheap compared to its history after underperforming since last year, and then again this year, beginning of this year. Asia is actually cheap relative to its own history. So basically, there is more value in Asia. Thirdly, of course, is that we believe China cannot cannot lock down forever. It will reopen, and as in any economy that we've seen, after a lockdown, the reopening actually stimulates economic activity. There'll be because of the pent-up demand, and we think that that would be an impetus and stimulus for growth and for market performance. So basically, those are some of the areas that we are thinking of. But in the meantime, we're still largely fairly well diversified in terms of our allocation for all the various portfolios, right? I've spoken for almost half an hour, so I'll hand you back to Roger, who may have something else to add.
Yeah, hi everyone. Thanks, Dharmo, for the insightful analysis in terms of how the markets have performed, and also in terms of how the various portfolios have performed as well. So before I go on, can I just move on to the next slide? Yep. So I gather that there are members of the audience today that are probably new to UOBAM Robo-Invest. So I would just like to quickly highlight a little bit in terms of who UOB Asset Management is, or UOBAM in short. So UOB Asset Management itself is actually a multi-award winning asset manager and financial advisor with over 30 years of investment expertise. And we are managing over 38 billion Sing dollars of assets under management as of 31st December 2021. So through this Dash partnership itself, right, UOBAM Robo-Invest is actually Singapore's first robo-advisor on a mobile wallet. So we have created sustainable investing solutions exclusively for our Dash clients. So probably let's move on quickly to the next slide. Yep. So if you were to notice, right now, we're actually having an ongoing promo right now. So from 1st of March till 30th of April 2022, as long as you top up $500 to your UOBAM Robo-Invest account, you actually enjoy $20 credit into your UOBAM Robo-Invest account as well. And at the same time, if you are existing Singtel mobile client, you actually get an extra 1,000 Dash rewards points, and that'll be great, in terms of for you to go and look through within the Dash app itself, and to use it for other purposes as well. So as we go on to the next segment, I just wanted to quickly run through in terms of some of the questions that we have gathered from our audience today. And it seems like the audience today has been quite, I think everyone has been quite concerned in terms of how the markets have been doing. So probably let me just pick up one of the first questions. Dharmo, probably just to find out, have we hit peak inflation in US and Asia ex-Japan?
Good question, and difficult one at that. Right before the China lockdown, we would think so, simply because mathematically speaking, we started seeing the month-on-month inflation number start to come down. I mean, obviously, it went from 0.5 to 0.3 on a month-on-month basis. So if we sort of tabulate those numbers, it's still a fairly high inflation, but it would have suggested that we've passed peak inflation. And over time, we would expect sort of the supply chain bottlenecks to be eased, meaning that any shortage usually triggers a supply response. As prices goes up, suppliers produce more, and then we sort of resolve the supply chain bottleneck. And we were expecting to see that in for example, in areas like semiconductors. And so we thought that the inflation would probably peak sometime in March or April. And that was partially because those were the high base, those were the low base last year. However, given that we are seeing further supply chain disruption because of China, we think that this might actually push back the peak inflation by a few more months. right, at this moment, and especially when energy prices and is now elevated, more elevated after the Russian invasion. This may also be another might be also be another situation, another factor that basically delayed the peaking of inflation. So that's a very long answer to the question, but if I were to distill it before the invasion and the China lockdown, we would have said, yes, now probably we think that the peak inflation would happen more like in the third quarter rather than what we've seen today.
Thank you, Dharmo. I think before we move on to some of the robo portfolio specific questions, probably another quick one is I think you have mentioned that in terms of we are going in, probably putting money into the Asia ex-Japan, and we say that, you know, within the region itself is cheap compared to historical values and all that. So there's this question asking about, you know, what are our views on the forward expectations on global equities, US equities, and Asia ex-Japan equities as well.
Okay. As we mentioned, right, so the base case is that the global economy will continue to grow, that we will not have a recession this year, despite all the shocks, that the economy can still withstand all these growth shocks. And there's a bit of hope in that, in the sense that what we've seen in the economic data that has come out so far suggested that the global economy remains strong, especially in the US, and even in Europe, the economy hasn't been affected as much as we feared. Right. So generally speaking, and if you look at the sort of PMI number, Purchasing Manager Index number, in the US and in the US is still about high 50s, and even in Europe is about high 50s. So basically, those are not bad numbers. Those are numbers that suggest that economy is still growing, and expectation is still that for the economy to continue to expand. Right. So that is still our base case. However, we do note that there are possibility of recession, as I mentioned, and there's also the margin pressure that we are mindful of. And where is that margin pressure coming from? One is, of course, higher energy prices, but most industries are generally now not very energy intensive, but things like cost of transportation have gone up, right? And labor prices have gone up, labor costs have gone up. I think in US, we see things like wage increase of about 4 or 5%, which is generally, that is actually probably one of the highest that we've seen in recent years, right? And if this gets filtered into the cost of business, we think margin might take a hit. So in that aspect, we think that this year would be challenging for global equity market. We still believe that we can get a sort of small positive return out of global equities, but there will be a lot of volatility. I think in the beginning of the year, we've already mentioned that we expect this year to return to be fairly modest, but with a lot of volatility. And it is starting to play out, right? So we are seeing this drawdown now, and then we are seeing rebound. Then after that, we hear some other shocks, and then we see drawdowns again. So it will be a volatile market, but we expect that equity market return would still be a sort of mildly positive this year. And among the areas that you mentioned, we think that the global market, what I mentioned just now was about the global market. So if we are talking about regionally specifically, US is interesting. US saw sort of is probably the epicenter in the sense of interest rate or monetary tightening and interest rate hikes. So that's really a point of concern for us. But US is also fairly insulated in a sense that because they're not involved in the Russian-Ukraine conflict directly, they are fairly insulated. And so far, the sort of local economy, the local US economy has been very robust. Housing market has been very robust. Job market has been very strong. So arguably, US economy looks pretty strong going for the rest of the year. So we think that US market probably would do fairly well. So, I mean, if today you ask me to choose between US versus Europe, I'll tell you I'll choose US. And if you tell me US versus Asia, I think that's probably a more difficult call. But US is generally probably going to do slightly better than the global market in that aspect, right? Asia, as I mentioned, Asia is really watching China, right? If China's lockdown is relaxed soon, then I would say that China would probably be doing well. Today, we are hearing the Chinese government saying that they are still committed to delivering 5.5% growth. And we think that what they say they would do, this would come from in terms of monetary easing, as well as government stimulus, fiscal stimulus from the government to boost the economy. So we think that those would probably be the engine for Asia. And of course, Southeast Asia has been doing pretty well and doing very well, partially because besides the fact that Asia is insulated, Asia actually benefit from higher commodity prices. As you know, Indonesia and Malaysia are big exporters of commodities like palm oil, coal, and rubber. So those are commodities that benefited from higher prices, and as a result, I think the Southeast Asian economy in general have actually done relatively well. And plus the fact that we are starting to reopen our borders, whether in Singapore, in Thailand, in Malaysia, that really will be another impetus for trade and for travel and for growth. So we think that Asia would do pretty well this year. But as I said, the biggest question really is how long is China going to lock down? We are hoping that it would relax soon, and if it can, then basically we should be doing relatively well this year.
Thanks, Dharmo. Before I move on to some more specific portfolio breakdown questions, I'll probably take one of these questions in terms of, I think there was a couple of them asking in terms of whether, if I'm already in an aggressive portfolio, do I need to consider switching over to another portfolio, since whichever portfolios I'm in right now are probably down as well. And I think there's another question asking about, ever since it has been invested, it has been seeing negative performance. So maybe just let me quickly address those two questions on my end in terms of where we are looking at. So I think what Dharmo has presented earlier, in terms of the portfolio's performance, right, we are seeing at the range of about 5% down. So as compared to what the Asian markets that we are seeing right now, is a lot more. So and looking at a period of time that's being invested so far, we're looking at about a quarter. So and from an investing perspective, we're always looking at, or rather, these portfolios are actually constructed and crafted to hold on to probably about 2 years or 3 years at a longer term basis. So and to be honest, across board for the first quarter of 2022, right? I guess most of the other robos are also down at this moment as well. So while we are concerned in terms of how the performance have fared for first quarter 2022, but as what Dharmo have presented over the last half an hour or so, right, we do see certain green shoots along the way. One example is what Dharmo has mentioned in terms of the Asian equity, Southeast Asian equities, and in terms of US equities as well. So I guess from this onwards, right, nobody likes to see negative performance, that's for sure. But from where we are looking out and from where the team is managing right now, right, I think that there's a lot of emphasis in terms of putting our eyes, putting our monitoring on all these portfolios to make sure that we do the best for our clients. So let me just quickly move on to Dharmo, do you have anything to add on?
Yeah, I think one thing that I like to highlight is try to resist the temptation of timing the market in terms of, oh, I've lost money and now I should withdraw, because or I was in an aggressive portfolio, but now I want to move to a more conservative portfolio as a result. I think if you have defined your risk profile properly, you've basically taken the sort of the hit on the way down. What you don't want to do is miss the rebound, right? So we've seen a lot of situation in which that people see a down quarter and then they try to time the market. They try to say, oh, I'll get out and come back again when things looks better, and you end up missing that rebound. So you only took the losses, but you didn't get the rebound, and that's what we call whipsaw. And that's basically one of those risks in when you actually have your emotion affect your investment decision. So to us, we always suggest that, especially in this sort of robo situation, we tend to suggest using dollar cost averaging, as a way to sort of to average down your cost of investments, and basically ride that rebound or ride that recovery rather than getting out at this moment. I think that's probably one thing that I like to highlight.
Yeah, thanks, Dharmo. I think that this question, which is talking about the allocation into the different sectors within the Robo-Invest, the audience today is looking at, there's a sell-off in tech, biotech, pharmaceutical, and whether, would there be any further impact in terms of performance in the next few months or years? Although we know that, Robo-Invest is set up in terms of regional allocation. So is there any allocation or any sectors within the portfolios itself that we are looking at, whether is it overweight or underweight? Maybe you want to share a little bit more?
Sure. I think, as you rightly mentioned, we don't allocate by industry sector. We allocate more by region, because we don't currently we don't do the research in terms of which sector we should be investing in. More looking at the economic cycle of different regions in our research. So basically, with that, we tend to favor the Asian market. Our least favorite, as I mentioned just now, was Europe. US is a bit of a mixed bag, but we think it will do all right. Bearing in mind, of course, US also benefit from the fact that more countries are now spending more on defense, and US obviously is one of the biggest exporter of defense contracts. So with that, we think US probably do decently. So we are bullish Asia, we are okay US, we are probably more bearish Europe, because we think that the impact of the Russian sanction would probably be more long-lasting.
Okay, thanks, Dharmo. Let me probably just take the second last question. I think there's this member of the audience actually holds on to the very aggressive portfolio. And I think he was asking, did we tweak to sell the US REITs within the very aggressive portfolio? And isn't the current portfolio, which I think you have shared earlier on, more volatile than the earlier portfolio, which I think it included US REITs into it? Yeah.
Okay, so I think the US REIT was taken off the most aggressive portfolio. I think, in fact, it was taken out of most portfolio. I think we only have one that is a little sliver left, simply because of the valuation, meaning that the REITs have done very well in the past couple of years. And because of that, the return expectation is now much lower, and especially after sort of the yield has compressed significantly. So with that, we basically, the allocation or the algorithm decides to get out of US REIT as a result, simply because of that valuation issue. And of course, US REIT is slightly affected by the interest rate expectation. As interest rate goes up, REITs tends to be a bit impacted. There is some buffer there, but you can't totally be insulated from the interest rate movement. So I think those were the two reasons why the US REITs were taken out of the portfolio.
Thanks, Dharmo. In the interest of time, probably just one last question. I think this one is probably on everybody's mind. How can UOBAM Robo-Invest help us, the investors and also the members of the audience today to improve on the poor performance I think we have seen so far for the first quarter 2022, and then probably you can share a little bit more in terms of how the team is moving on, looking forward, and keeping track in terms of what we are doing, and then probably relying a little bit in terms of our CMAs and the setup of the portfolios as well.
Sure. As Roger mentioned, we do have a group of senior investment team that basically look at the CMA that goes into the Robo-Invest carefully. The team is made out of 5 people, and I think among the 5 of us, we have probably more than 1 century of investment experience. And what we do is that we look at the expected return and the expected volatility of each asset class carefully, and deliberate and debate about it before we put it in the robo. However, we also emphasize that these tends to be sort of long-term mid to long-term expectation, right? So it is not going to be, it might not play out immediately in the next quarter or next month or next quarter, but we think that in the medium to long term, it will play out. Buying things that are cheap, buying things that are cheap relative to its own history, will ultimately play out. And basically we let the robo optimize your portfolio to formulate a portfolio to maximize your return based on a specific risk target, or specific what we call volatility target, right? So if you are conservative, we expect your volatility to be about 3%, and that's sort of we expect a return of, roughly speaking, about 4% for that kind of portfolio. And we think that over time, that 4%, we would deliver that 4%. And so today, if you're down 2, we think that it will ultimately catch up, that you have a 4% annualized return in the long term. But it will take a bit of patience. It may not happen in the next quarter or even for this year, right? So in this year, if we think of it, it might be that we would catch up and you'll probably be up slightly, up a couple of percent, but in the long run, this portfolio would probably deliver that 4% for you. And on the other hand, on the very aggressive portfolio, given that the volatility is such that you are taking almost all equity risk, we expect roughly about 6-7% return for that sort of portfolio in the long run. Again, it may not happen next quarter, But we are fairly confident that in the long run, that 6-7% would still materialize.
Thanks, Davo. I think in the interest of time, probably I'll just quickly sum up some of the burning questions that the clients are looking for in terms of improving performance and then looking at it. I think the key thing is also about, I think what Dharmo has mentioned, which is not to time the market. So if you are a long-term investor or if you are a keen investor, probably one of the ways to do so is also what we call dollar cost averaging, trying to go in on a specific periods of time over the past 1 quarter, and that's where you actually get to dollar cost average and lower down the cost itself by taking advantage of the different scenarios in the markets when the markets are down. So we can't be looking at trying to time and then trying to give a pun in terms of where we're going in. So I feel that the key message to our audience today is really in terms of where we are looking at in terms of our markets that we are favoring. Number two, in terms of how do we address it, how do we approach it if you want to be invested into the market itself, probably is to, you can do your own dollars cost averaging by going in on the specific amounts on a regular basis itself. That's actually will help you to actually lower down the cost on the overall basis. So I think that will actually greatly benefit in terms of your portfolio so that you do not jump in and out and switching different portfolios and not trying to time the market. So with that, I would like to end today's session, and I thank everybody for your time. If there are any further questions, feel free to reach out to us, and we'll be more than happy to help you. Yeah, thank you.
Thanks, everyone.